What is unrealized appreciation? Hi everyone, my name is Tan and I'm independent certified financial planner practitioner at Tan Wealth Management. Today's educational video is on net unrealized appreciation strategy. What is net unrealized appreciation? NUA. Net is gross minus expenses. The fair market value of the employer stock minus the cost base of the employer stock equals the net profit or loss of the employer stock. Unrealized appreciation is the paper profit of the employer stock. It's realized when the employer stock is sold. For example, you have investment in your accounts that go up and down daily. That is the unrealized gain and losses because you have not sold the investment. When you sold the investment, you realize the gain or losses of the investment. What is net unrealized appreciation strategy? When we have employer stock in a defined contribution plan, such as in a 401k plan or an employee stock ownership plan, ESOP, we can transfer the employer stock in kind during a qualifying event, pay earning income tax rates on the employer stock cost basis, and pay long-term capital gains tax rates on the net unrealized appreciation amount, which is the difference between the employer stock fair market value and cost basis. To do the NUA strategy, we must first satisfy three requirements. The employer stock must be transferred in kind. It's part of a lump sum distribution. And satisfy a triggering qualifying event. The net unrealized appreciation qualifying events are separation from service. We are no longer with the company. Reach age 59 and a half. Death. Or total disability for self-employed worker. If you are not self-employed and you work for a company and become totally disabled, chances are you are no longer with the company. Thus, you can trigger the event of separation from service. For example, Luna is separated from service when she is 40 years old. She had an option to do the NUA strategy but didn't because she didn't know about the NUA strategy. The next time she can do the NUA strategy is when she is 59 and a half years old. If Luna passes 59 and a half years old when she separated from service and didn't do the NUA strategy, she had to wait for another qualifying event. If she doesn't have a qualifying event to do the NUA strategy, her beneficiary can do the NUA strategy when she deceased. The two net unrealized appreciations taxable events are 1. A taxable event when we do an NUA strategy. We pay earning income tax rates on the employer stock cost basis. 2. A taxable event when we sell the employer stock. We pay long-term capital gains tax rates on the net unrealized appreciation plus any gains above that amount will be taxed at long-term capital gains tax rates if we held the employer stock more than 365 days and short-term capital gain tax rates if we held the employer stock for 365 days or less. If we have a subsequent loss instead of a gain, we can claim a loss as capital loss. Net unrealized appreciation strategy examples. To better understand the net unrealized appreciation strategy, let's look at some examples. Luna has $1 million of employer stock in her 401k plan, consists of $500,000 in the employer stock cost basis and $500,000 in the gain on the employer stock. She is subject to the highest federal tax rate of 37%. She is subject to the highest long-term capital gain tax rates of 20% plus net investment income tax of 3.8%, which equals 23.8%. Example 1. Luna rolled over her 401k plan of $1 million to a traditional IRA. At an 8% rate of return for 10 years, the total account value of the IRA is $2,158,925. The federal tax rate of 37% times $2,158,925 equals $798,802, which is a tax payment. The net value at the end of the 10th year is $1,360,123. Example 2. The net unrealized appreciation strategy. Luna rolled over $1 million of her employer stock to a brokerage account. Luna has to pay taxes on the cost basis of $500,000. $500,000 times the highest federal tax rate of 37% equal $185,000. Luna has to pay taxes on the cost base of $500,000. $500,000 times the highest federal tax rate of 37% equals $185,000, which is the tax payment. The opportunity cost on the tax payment of $185,000 for 10 years at an 8% rate of return equals $214,401. She has to pay long-term capital gain tax rate plus net investment income tax of 23.8% on that money, which equals $51,027. The net gain opportunity cost on the tax payment at the end of the 10th year is $163,374. The total opportunity cost on the tax payment at the end of the 10th year is $348,374. The total account value in the brokerage account is $1 million. Cost basis $500,000, gain of $500,000. The number of year is 10. Rate of return is 8%. At the end of the 10th year, the account value in the brokerage account is $2,158,925. Cost basis $500,000. The net gain is $1,658,925. And she has to pay long-term capital gain tax rate plus net investment income tax of 23.8%, which equals $394,824. At the end of the 10th year, the net account value after tax in the brokerage account is $1,764,101. The total opportunity cost on the tax payment at the end of the 10th year is $348,374. At the end of the 10th year, the net account value after tax is $1,415,727. Roll over to an IRA or do a net unrealized appreciation strategy. Difference is $55,604. Example 3. If Luna has $1 million of employer stock in her 401k plan, consists of $200,000 in the employer stock cost basis and $800,000 in the gain on the employer stock. Retain employer stock of $200,000. Ordinary income tax rates of 37% on that money equals $74,000. The opportunity cost on the tax payment of $74,000 for 10th year at a rate of return of 8%. The gain on the opportunity cost on the tax payment at the end of the 10th year is $85,760. The long-term capital gain tax rate plus net investment income tax of 23.8% on that money equal $20,411. The net gain opportunity cost on the tax payment at the end of the 10th year is $65,349. The opportunity cost on the tax payment at the end of the 10th year is $139,349. The total account value in the brokerage account is $1 million. Cost base is $200,000 and a gain of $800,000. Compounding for 10 years at an 8% rate of return. At the end of the 10th year, the account value in the brokerage account is $2,158,925. The cost basis is $200,000. The net gain is $1,958,925. And we have to pay long-term capital gain tax rate plus net investment income tax of 23.8% on that money, which is $466,224. At the end of the 10th year, the net account value after tax in the brokerage account is $1,692,701. The opportunity cost on the tax payment at the end of the 10th year is $139,349. At the end of the 10th year, the net account value after tax is $1,553,351. roll over to IRA or do the net unrealized appreciation strategy difference is $193,229. What did we learn from these examples? NUA strategy is good when we have a very low cost basis in the employer stock. If we roll over our defined contribution plan to a traditional IRA, we can have tax deferral and the ability to do a Roth conversion in the future. There is also an opportunity for our spouse to roll over our IRAs to theirs when we are deceased. This can stretch the plan distribution for many years. Disadvantages of the NUA strategies are: we need the money to pay for the taxes on the employer stock cost basis when we do the NUA strategy. Opportunity cost on the tax payment. Every time we spend $1 on something, we are not spending that dollar on something else. That is the opportunity cost. We are giving up tax deferral. We are giving up the ability to do a Roth conversion in the future. No step in basis in the employer stock. The unsystematic risk associated with holding an individual stock. In theory, we do not compensate investors for unsystematic risk because the risk can be eliminated through diversification. Examples of unsystematic risk are management risk, business risk, and financial risk. What did I personally do with my employer stock in my 401k plan? When I was at Prudential Financial, I had Prudential Financial stocks and mutual funds inside my 401k plan. I could have done the NUA strategy by transferring in kind the Prudential Financial stock to a brokerage account and the mutual fund to a traditional IRA. I didn't do that because having Roth money is more important to me than paying long-term capital gains tax rates on the gain of the Prudential Financial stock. I transferred all of my 401k money into a traditional IRA, then did a Roth conversion when the market was down in March 2020. I know my taxable income will increase because of the Roth conversion, but in the long run, I know I will be better off because all of that money in the Roth IRA will be tax-free to me when I use it in the future. Should conservative investor do the NUA strategy? Don't make investment decisions solely on the tax implication. If we are a conservative investor, we should not have a high concentration in a stock position. Although the tax benefit makes sense to do the NUA strategy, after we did our analysis, we should not do the NUA strategy if we are conservative investors. I know we can do the NUA strategy by paying ordinary income tax rates on the employer stock, strategically selling the employer stock and being taxed at long-term capital gains tax rates on the net unrealized appreciation. Then take the money and invest in a diversified portfolio. The risk here is the employer stock price could decline dramatically when we want to sell the employer stock. Thus, conservative investors should think twice before doing the NUA strategy. Does the 3.8% net investment income tax apply to the net unrealized appreciation? Under Treasury Regulation 1.411-8, exception for distribution from qualified plans, the 3.8% net investment income does not include any distribution from a qualified plan or arrangement. For this purpose, the term qualified plan or arrangement means any plan or arrangement described in Section 401A, 403A, 403B, 408, 408A, or 457B. Does the 10% early withdrawal penalty apply to the NUA strategy? We could be subject to the 10% early withdrawal penalties on the employer stock cost basis if it's not a qualified distribution, such as not reaching age 59 and a half. For example, Luna is 50 years old and her employer stock cost basis is $10,000. She did the NUA strategy. $10,000 is taxable at earning income to her, and she may also be subject to the 10% penalty, which is $1,000. Net unrealized appreciation strategy insight. NUA strategy might make sense if we need the money to achieve our goals, such as a down payment on a house, start a business, etc. If we need the money and don't do the NUA strategy, all the proceeds will be taxed at earning income tax rate. If we do the NUA strategy, the employer stock cost basis will be taxed at earning income tax rates, and the net unrealized gain will be taxed at long-term capital gain tax rates. Thus, we can save money in tax by doing the NUA strategy. The best time to do the NUA strategy is when we have a very low cost basis in the employer stock. Cherry pick the employer stock that makes sense to do the NUA strategy. It doesn't make sense to do a NUA strategy when the employer stock is in a profit sharing plan, like a 401k plan. We can sell the employer stock, then do the NUA strategy. That way, we can transfer in kind the employer stock we want in a brokerage account, and the remaining investments and money inside the 401k plan can be rolled over to a traditional IRA, and we can take advantage of all the benefits that come with a traditional IRA, such as tax deferral and the ability to do a Roth conversion. Before doing the NUA strategy, make sure we are qualified to do it. Talk to a professional that knows the ins and outs of the NUA strategy. I like to be on a conference call with my clients and their employer or ex-employer human resource department, so I can ask their human resource department's specific questions related to their plans. Tax rules are constantly changing. What is correct right now might not be correct in the future. Always talk to a qualified professional before making any financial decision. If we do the NUA strategy wrong, the full value of the plan can be taxed at earning income tax rates. What are your thoughts on the NUA strategy? Does it make sense to do it? Thank you for watching. This is Tan, your trusted advisor.